Hi everyone, it's Stephen here. Buying for cash flow or capital appreciation is one of the most important decisions you need to make when you invest in property. Now, to those of you who've said you want both, you cannot choose both as an option, and I'll explain later why this is the case in this video. Get this decision wrong and you could be paying a high cost, both in terms of time and in terms of money for years to come. I started my journey unaware of the importance of this decision, but I stumbled across the answer after buying my first investment property. To help you understand why you would choose one of these over the other as an investment strategy, I'll discuss each of them with some examples, the areas to look in and some tools that will help you speed up the process, and which strategy you should be using if you want to be a property investor. Cash flow investing is a way to generate another income stream. Most people that want to quit their job will choose this strategy as it's a way to live life on your own terms and not be a slave to their jobs for the rest of their working lives. To buy a cash flow property, we need to determine if that property is positive cash flow. Then we can use it as a comparison between different properties. To do this, we work out the income that's generated from the property via the rent. We deduct that from the expenses, so things like the mortgage, the utility bills, property management and maintenance. Then we're left over with a number, and that number should be a positive number, which means that it's paying us every month, it's putting money into our pocket every month. If it's negative, that means it's taking money out of our pockets every month, and that is keeping us in our job. So when it comes to capital appreciation, the primary focus here is capital growth. So what we want to be seeing is that the property value is going up over time. So as an example, that you buy a property for £250,000 and in 5 years time, that property is worth £300,000. So in 5 years, you've made £50,000, which is equivalent to £10,000 per year. The focus here would be on areas that have historically shown good capital growth and have outperformed the average of other areas. And I'm going to show you some examples in a minute on this. Growth in areas is typically driven by the supply of local jobs, good transport links, and lifestyle amenities that are available. Before I get into some examples with cash flow and capital appreciation and the types of areas we should be looking in, I want to be addressing the question about why we can't do both. To invest in property, we need to be focused on one primary strategy, because to focus on both cash flow and capital appreciation cannot be done in simple terms. Focusing on one strategy will allow you to narrow down to a specific area, even down to that particular postcode, to give you the best outcome for whether it's cash flow or it's capital appreciation. So let's say it's cash flow. You'd be looking for the highest return that you can get for your money from that investment property. So essentially making the most money in the quickest time with the least amount of risk and the least amount of aggravation. So if I was trying to do both, I would find that the highest capital appreciation properties would have the lowest returns, and the highest returns property would likely have the lowest capital appreciation. So this way we've got conflict of interest if we're trying to do both at the same time. We have to pick one and be mindful of the other one, but one has to be our primary, the ultimate decision maker when we're looking at property, because that's driving us forward with what we're trying to achieve as the outcome for that particular investment property. So it doesn't mean that we're forgetting about the other one, it just means we use one as the driving factor to help us choose between property A or property B. Looking for positive cash flow properties is harder to do than looking for just ones that appreciate in value. This is because it takes time, we need to research, we need to look into different areas and work out which ones have got the highest return. Rightmove does help us out here with some analysis that they've done as part of their rental price tracker. So here they've broken down the country into regions and are showing us which regions are performing best from a return perspective. We can see that the best performing ones are in the North East, Wales and Scotland right now. And we can see that everywhere's growing because over the last 12 months as a whole, the rental market's increased by 11.6% as of the time of recording. So the data here is just averaged by the region, so it's not drilled down. But what it does tell us is which areas we can initially look into if we're looking for areas that will give us the best return. Having said that though, you can achieve better returns down south, and this would be if you use a strategy where you're using houses of multiple occupancy or annexes or something like that. This is because more people renting the same shared house You can rent stuff by the room, and therefore overall you get more money than if you just to rent the whole house to one particular family. Rightmove produce some regular reports which also drill down into these areas and show you which areas have got the best returns, and also some hotspots for buy-to-let investing right now. And I'll link to this report just below in the description. From this report, we can see that the North has had the best returns and has also had a few areas with the highest change over the last 12 months. So looking at their rental yields, we can see that generally most of them are in the North. All the top performing ones are in the North, with a few there in the South, just under 6%. And I'm taking this data from data that was published in July 2022. In this next section, they deem some hotspots that you could focus on, where you've got the biggest change in the amount of rent that these particular areas have been generating. So at the top there, we've got Manchester with a 23% improvement over the last 12 months. And we can also see in that list there's a few in the south, with Farnham and Bristol being kind of standout ones that would be good for capital appreciation as well. So when we look at the cost of property by region to look at the capital appreciation, we're seeing that the cheapest house prices are generating the biggest returns when we look at the data. But one consideration is wherever you buy, you're going to need to have that deposit available for that particular area. So the deposit that you've got available may dictate where you eventually end up buying, because if you've only got a small deposit, you have to go to the cheaper areas, but you're going to generate potentially a bigger return, but therefore your thing's not going to be more so around capital appreciation. And you may think, well, I don't live near these locations, so I can't invest there, so I need to spend more time saving up before I only want to buy within a 10-mile radius of where I live. Now, that isn't always the best investment strategy to do. And I'll explain why, because I've bought properties in other countries and it doesn't really worry me where the property is. What I'm looking at is what's my ultimate driving factor when I'm buying that investment property. So when I bought these properties in the other country, it was in the US, I bought them during the global financial crisis. And during that time, prices in the US were cheap. No one was buying property. So it was the best time to buy. When no one's buying, you buy. And so you could pick up these houses that were worth 5 times more at the height in 2007 for dirt cheap in 2012 to 2014 kind of range. When you're buying properties in areas that you don't know, you just need to make sure you've got a good property manager in place that you can trust. And this is exactly what I did. I flew out there, got a good property manager in place, put offers in on the houses, came back, still put offers in on the houses remotely, sight unseen, don't need to see them. As long as the numbers make sense, I was happy to buy them. Because I kind of knew the area, walked the streets, done all of that, was over there for a good few weeks, sussing that all out. And you can do the same with buying property here. You just go up to wherever it is, the northeast, northwest, east of England, southwest, wherever you are not based, go and spend some time in that area, suss it out, go and talk to estate agents, go and find some property managers that you can trust, that seem legit, got good reviews, referenced by other people, and then put your trust in them, and they'll reward you with their trust, and you'll see that you can potentially then make good cash flow from those types of properties that aren't necessarily within touching distance of where you live. There's also Property Data, which is a subscription service. It's not too overly priced. It's quite reasonable, especially if you're doing property investing and this is what you want to be doing and build up your property portfolio. It's probably worth investing even into the basic plan, so you can easily suss out areas. And I'll put a link below to Property Data, as it's something that I use. And in Property Data as well, we've got some yield hotspots again, so where's the best returns and what you can kind of get from HMOs in different areas, which they regularly update on their website. You can just quickly go and have a look at them. So based on the data that we're being told, the Northeast is best for cash flow. So let's have a look at how well the Northeast has performed on a capital appreciation perspective if we want to want cash flow, but we'd also like to think, well, are we going to get any capital appreciation at all, or we just should write that off? This is something that you should always look at when you're looking at a property in a particular area, because there might be some kind of trade-off between, okay, well, cash flow, but I'm happy to take a little bit less cash flow if it means that the appreciation is definitely going to kind of happen to some extent. If it's just going to be dead for decades, then that's fine, as long as you go into it eyes wide open. So what I've done when we're looking at the Northeast, I've gone back 10 years from now. So we're kind of August 22 now, gone back to August 12, and we can see that the starting point for, say, a terrace is 96,000, nearly 97,000 pounds, and then it didn't really improve. In 2020 still, that terrace that was 97 grand is still only worth 99,000 pounds. So in 8 years, it's kind of gone up a few £1,000s. So that's the northeast. But in the last few years, last couple in fact, where everything's exploded, it has now gone up to around £124,000. But you'd get that from wherever you'd invested. So if you'd have sold this property in January 2020, you could have owned it for 8 years and it would have had zero capital appreciation in that time. So with capital appreciation, you kind of need to just sit on it for as long as possible if you want to definitely generate some kind of appreciation, and then you'll make some appreciation even in these areas that have historically not made that much money over time. So that terrace then has gone up overall 27.5 grand in 10 years, which is a 28% return over that period of time. If we look at detached then, they started at 196,000, they're now worth 264k, so that's a 68,000 return in 10 years, being around 36% return. So not too bad either. But then when we compare that to the southeast, we look at the terraces here, and they've gone up in the same period £100,000. So they were at £189,000, they're now worth £289,000. So they've gone up 53%. So if you could afford to have bought a terrace for 189 grand instead of the terrace in the northeast for 90, in the low 90s, so you needed 100 grand more, but when you're borrowing, it's only 20% of that, so it's another 20 grand. And when it comes to detached houses in the south, these started at £392,500, and then in 3 years' time, they've already gone up by £100,000 to £493,000. So we can see that in the south, capital appreciation is happening a lot quicker. We can see that the detached has gone up by £300,000 in 10 years. So from £392,000 up to £691, nearly £2,000, it's gone up £300,000 approximately, which is 76% increase. So earlier before I said that you could make money in the southeast with capital appreciation and cash flow. And the way that I'd do this is I'd look for HMO properties to buy, or I'd manufacture a HMO property from a normal family house. So on the market right now, there's this HMO that's available for sale in Hounslow. So they want £685,000 for this particular property, and it generates an income of £60,000 per year. But it's in need of modernisation, all the rest of it, and there's a reason why they're probably selling it. So you go into it understanding these potential issues that you're buying. But either way, Hounslow data is showing that a semi-detached property, which is what this one is, 10 years ago was worth £364,000 average. It's now on average worth £639,000. That's gone up £275,000, which is a 75% increase over that period of time. So you could buy this property that cash flows and has capital appreciation in it. But ultimately you'd be buying this one for capital appreciation, because the cash flow is secondary. Because you're buying it in the south, you're looking for capital appreciation, but you want good cash flow returns as well, if you can, and that's the cherry on the top. But with HMOs, there's all sorts of different things you need to be thinking about, which we're not going to go into here, but so you can get these types of properties if you look for them in the south. So which approach should you choose if you're a property investor? So if you're buying property for cash flow, you're going to be making money no matter what the market's doing. If you're buying property for capital appreciation, you're not investing, you're just hoping. Having said that, if I was looking to quit my job, I'll be buying positive cash flow property. And once I've achieved that goal, I would then look to buy the next one being a capital appreciation property, so I get some capital appreciation and benefit from anything that the market's doing if it's going upwards. Because we know, leave anything long enough, it always goes up in value. Look at inflation right now. So this is what I would do. And then the next property after that, maybe you look at positive cash flow. So you start to balance out your portfolio, and the one after that, capital appreciation. You can go in and out, but your primary focus is cash flow for the next one, and then it's capital appreciation. You can't do both for the same thing. You can only kind of choose one as your primary, and then the other one can help you make a bit of a decision. And this way, by buying some for capital appreciation, you might be buying properties more in the south, which will help balance out your portfolio if you bought a load of cheap properties up north. One of the biggest problems when buying for cash flow is working out which location to start looking in. So you want to be looking at this video next, because this will tell you which are the best areas, as well as which are the best postcodes to buy investment properties for under £150,000 that will start generating positive cash flow from day one.